to the session. We'll also learn today about the Asia School of Business and opportunities that you have available for pursuing an MBA program there. Good to see Siddhartha coming in from Hyderabad as well. Lovely. We'll wait for just another minute before we move forward. We are now also streaming live on YouTube. For any of you that want to have a look at the session later, it will be available on our platform, Seed Global Education on YouTube. So before we move forward, let's do a quick poll question. A question should appear on your screen in the next minute. Tell us, what is the most important factor that you think about when choosing a study destination? Is it the quality of education and faculty expertise? Is it the cultural diversity and international exposure? Is it tuition and cost of living affordability? Is it the opportunities for networking and industry connections? Or is it the brand recognition and rankings that matter to you? When choosing a destination, which factor is most important to you? We'll wait for a minute for responses to come in. It's a quick single choice for everyone that you can see this question on the screen. Which factor out of these is most important to you when choosing a study destination? Quality of education or faculty expertise, cultural diversity and international exposure, tuition and cost of living affordability, opportunities for networking and industry connections, or brand recognition and global rankings? All right, we'll move that question off. Let's see what kind of response we're seeing now. Lovely. So quite a spread. Nearly about 30% of you are focused on quality of education and faculty expertise. About 40% of you are thinking about opportunities for networking and industry connections. Nearly 15% of you are thinking about tuition and cost of living. And similar percentage are looking at brand recognition and rankings. A very small percentage looks at cultural diversity and international exposure as well. So today's session will help you understand a little bit more about how ASB offers you many of these opportunities too. But before we do that, let's learn a little bit about mergers and acquisition. On today's topic, as I mentioned, we've got Jake Cohen, who's the Senior Associate Dean and Senior Lecturer at MIT Sloan. Jake started his career in M&A with PwC and transitioned into the world of academia, starting to teach initially at Harvard Business School, then at INSEAD, then at MIT via using M&A and via case studies, and has developed through various transactions. He's also served as a consultant at Blackstone, BCG, and many other organizations as well. Now, many of you that are attending today received a case study via the reminders as well. So we're going to cover that in due case too. But without further ado, I'd like to hand over to Jake to talk to us about guiding us through the process of M&A.
Great. Thanks, Paras. Hi, everyone. It's good to be with you. It's a beautiful day here in Cambridge, Massachusetts in the US, and I know it's quite late at night for you, wherever you are. And I appreciate you joining so late, and I'll try to make it as interesting of a session as possible. But again, thank you so much for joining us and learning more about mergers and acquisitions, and of course, the Asia School of Business, which is dear to my heart. So if I may, I'm going to share my slides, and we'll go through some material, and I'll talk about how it ties to some of the things you will learn in business school, and specifically around the topic of mergers and acquisitions. So how should we start? I guess I would start with the fact that this is the material that we teach at MIT. I teach this in a number of programs, in exec ed programs with lots of senior folks coming from industry. We teach the same material at the Asia School of Business. In fact, I do that personally, as many of my MIT colleagues do as well. So these slides are actually slides that we use fairly regularly and often at MIT and at ASB. So we're going to talk about mergers and acquisitions, but what is mergers and acquisitions, and where does it fit within the strategy of companies? I would say that it's part of the capital budgeting decisions. And capital budgeting decisions is really thinking about what are good investments and what are bad investments. So it comes to an understanding of what is an investment. How do we define what is good and what is bad? What are the value drivers of an investment? And the concept that we often use is net present value rule, the NPV rule. So again, these are topics that you'll cover in an MBA program in courses like finance and strategy, and I'll highlight various things you will see. But I would start with mergers and acquisitions are part of capital budgeting and deciding whether companies should look to grow through or acquisitions or just through organic growth. Okay, so again, I'm jumping to material you'll get to learn in business school, but this is the NPV decision. And it looks very complicated, especially for folks who've never seen this before. But in essence, it just shows lots of cash flows that are out and cash flows that come in. So CF stands for cash flows, and this is the time period and time zero, meaning right now you have to spend money. You have to spend money today with the hopes of getting more money in the future and making a decision whether the amount that you're getting in the future is more than the amount that you're spending now. This is similar to any decision you make. What's a good investment? Well, a good investment is to spend $10 if you get 11 or 12 or 13, because clearly if you're getting 13 for something that you paid 10 for, you created value of 3. Now, if you spend $10 and in the future you only get the equivalent of 6, then clearly that's not a good investment. That's a negative NPV investment. And again, in business school, you'll learn how to build this model, which is very important. But in a simple way of thinking about it is if you compare money today, how much money you're spending today, and what's the equivalent of the money you will receive in today dollars, if you are spending more than you're receiving, you shouldn't do it. If you're receiving more than you're spending, you should do it. And you should think about this in various things, including a decision to maybe go to business school. Should you go to business school? Well, you're going to have to pay tuition. What are you going to get in return for that tuition? If that value is more than the tuition cost, then you should do it. And if it's less, then you shouldn't do it. It's really a positive or negative NPV. And in mergers and acquisitions, companies think the same way. Should Microsoft spend, $67 billion to buy Activision? Well, they should pay $67 billion only if they think they're getting more than $67 billion. If they're going to get less than $67 billion, it's a negative NPV decision, and they shouldn't do it. So again, these decisions are very, very important. And in business school, you'll learn about how you model, project those expected future cash flows that show up in green, how you think about discounting those cash flows from the future to today, thinking about the cost of capital, and then doing the comparison between the outflow and the present value, the value today of all the future money that you will get. So this is something you will see and you will learn and you'll get very comfortable with in business school. But truthfully, maybe you need to think about it before business school, because as you consider making a decision around going to study, this is something that you can apply as well. Now, there are lots of alternatives to NPV. You'll learn about those in finance courses like IRR. And IRR is the internal rate of return, and you can figure out whether an investment is a good investment or a bad investment based on the IRR. If the internal rate of return, the return you get is more than the cost of money, then it's good. If the return is less than the cost of money, it's bad. Again, you will discover and explore that more in business school. And another way to look at it is something called the payback period. If you can recoup your money, if you can get paid back within a period that is shorter than some cutoff period, then that's good. And if the payback period is longer than this arbitrary cutoff period that is important to you, then it's bad. And these are the three most important ways managers make decisions around what is a good investment and what is a bad investment. The NPV, the IRR, and the payback period. Now, again, we went through that very quickly. You will learn about this in business school, but let's start to think about applications too. We often talk about the role of managers. What's the role of a manager, a CEO, a CFO, the COO? And it's to create value. Value creation and value capture. Again, words we often use in business school. Words that McKinsey and BCG and the various consulting firms often think about as they advise their clients. So how do we think about value creation? What is the role of C-suite executives? What is the job? Once you come to business school and you graduate and you go out and work, what is your job as you rise through the ranks to be a C-suite executive? Well, it's to maximize firm value. And I purposely wrote firm value to highlight some, issues that people talk about. Firm value, everyone can agree on, but is it maximize shareholder value? Is it maximize stakeholder value? That debate that has gone on for decades is very much with us again today to think about what is the role of C-suite executives. Is it to really just focus on shareholders, the residual claim holders, or is it to think about society? Is it to think about environment? Is it to think about suppliers and employees and customers and of course shareholders as well? What is the objective? And there is a discussion that's been raging for decades. And of course, if you follow things like ESG, if you look at some of the comments from some of the biggest firms like BlackRock and others, the asset managers, many people have shifted the pendulum to maximize stakeholder value, not just shareholders. But I put it here as maximize firm value, which I think everyone would agree with. Now, if we focus on shareholders, because shareholders are an important stakeholder, we need to understand that investors, shareholders, buy equity, stocks, for the purpose of making money. They're not making a philanthropic gift. They are buying a stock because they hope that they can make a return. And investors can make money really in two ways. One is to see the stock price go up. So maybe they bought Amazon, maybe they bought Tesla, maybe they bought whatever company you want to think about. And they did that because they bought it for $200 Tesla stock, and they hope that Elon Musk and the management team at Tesla drives the stock up to 220 and 240 and 270 and 300 and even higher. And that's the reason they're buying. Other stocks, people buy not only for the potential of stock appreciation, stock price appreciation, but also for the dividends. Now, Amazon and Tesla don't pay dividends. Dividends are distributions that the board of directors can decide to declare. And some companies that have lots of earnings, but not necessarily opportunities to invest those, pay dividends. So if you think about the utility companies, if you think about many of the large mature companies, they earn a lot of profit and they pay those in the form of dividends. So shareholders will buy stocks either because they're looking for the stock price to go up or because they're looking for the dividend payout. And often they look for the combination, what McKinsey called total shareholder return, TSR. And that's really a combination of both. So if you buy Coca-Cola stock, Coca-Cola pays you a 3% dividend, but obviously you're not buying Coca-Cola stock for 3%. You can buy something that's less risky. You can buy a government bond that would pay you more, but because there's also the potential for the stock price appreciation, you're willing to buy Coca-Cola or Procter & Gamble or any company that has the combination of stock price appreciation potential as well as dividends. So again, these are all decisions that the board of directors, corporate governance, very important topic you will cover in business school, focus on. Should they declare a dividend, or should they continue to take all the profits the company is generating and reinvest it in the company to promote growth potential, investment ideas? Which investments? Only ones that are positive NPV. Please don't make negative NPV decisions. Rather, use the profits that you're retaining to invest in positive NPV projects. Apple has done that superbly, and Apple has become the company we all love because of it, worth over $3 trillion, because they're very, very good at taking the earnings and reinvesting them in positive NPV projects like iPhones and iPads and iWatch and many other products that I'm sure they're working on. We'll see if they come out with an iCar. Now, again, in valuation that you'll learn in finance courses, there are really a number of ways of looking at valuation. One is called DCF, discounted cash flow models, where you need analysts who are graduates from MBA programs who go work at Goldman Sachs and Morgan Stanley and all the other big banks, the international banks like HSBC or in Singapore, Hong Kong, and elsewhere, in India, in Kuala Lumpur. They work at the banks, and their jobs is to forecast the future cash flows. And this equation here calculates the value of an equity by looking at the future cash flows, discounting it to today, and that's why it's called discounted cash flow model. It's a very rigorous model that requires you to really think about macroeconomic conditions, which is economic courses you'll take in business school. It requires to think about competitive strategy, how a company competes with its peers. Should you buy Ford or GM? Should you look at EV? Should you look at companies in China? What about the German car manufacturers or others? So competitive landscape. You should understand the management team, who's running it, what are the various backgrounds they have. All those things come into this DCF model, and the analysts who work as equity research analysts at the various banks like JP Morgan Chase and others, their job is to know that industry cold, whether it's the automotive industry, whether it's the pharmaceutical industry, whether it's the software industry. And of course, in today's world, everyone is thinking about AI and how that will change the world as well. So that's one way of doing valuation. The other way of doing valuation is using multiples. You might have heard of multiples like price to earnings or price to book. It's relative valuation, looking at valuation based on some value driver, which is the earnings, and then applying a multiple to it, a PE multiple of 15 times to the earnings, which means the price of the stock should be whatever the earnings are times that 15 multiple. And that is based on industries and based on how the market is doing. So again, lots of issues that you will explore in business school. And for investment bankers, for consultants who work at McKinsey, Bain, BCG, and many others, they need to understand these topics quite well as they advise their clients on whether growth through acquisition makes sense. Now, again, mergers and acquisitions is just one way to grow. Actually, Apple has been very shy and reluctant to do growth through acquisition. Most of Apple's history has been growth that is organic, meaning the company, Apple itself, develops through research and development products and services instead of going out there and buying other companies. They do small acquisitions, but most of their growth has been organic growth, versus other companies are serial acquirers. They grow by continuously buying companies, and they roll up industries to often be the largest company in the industry. Like in the telecommunications sector, you might have heard of a company in the past called WorldCom. WorldCom became the largest telecom company in the world, largest telecommunications in the world, through many, many acquisitions. And I'm sure their investment bankers and their lawyers and their accountants and their strategy consultants were on speed dial and were doing lots and lots of work in mergers and acquisitions to support WorldCom's growth. But you know what? Mergers and acquisitions often don't work. And what that means is those investments are negative NPV, which means bad investment. What it means is you spend more than you get. You spend 10 and you get the 6. Why would you ever spend 10 to get a 6? You want to spend 10 to get 13, but not to get 6. But despite 30 years of evidence demonstrating that most acquisitions don't create value for the acquiring company, the amount they spend is less than they get, executives continue to make more deals and bigger deals every year. And over the past couple of years, there's been a lull that's been fairly quiet in mergers and acquisitions, in part because of COVID. But now we're starting to see a little more pickup in transactions. But they should be careful, because history shows that most transactions destroy value. And when I say most, many people will use the number 70%. So 7 of 10 transactions will actually end up being bad investments, creating a negative net present value. Spending 10 to get 6, that's not good. Here's an example. There was a big deal, this is now a few years back. Quaker Oats, which I believe some of you know Quaker, and I hope some of you also know Snapple. So Quaker Oats decided to acquire Snapple for $1.7 billion. And immediately, as soon as they announced this transaction, people said, what? How much are you spending? 1.7 billion. And the analysts, who are the MBAs who went to top business schools like ASB and others, said, we think you overdid it. You spent 1.7. Wow. Ouch. We expect that you probably wasted a lot of money, and you probably overpaid by $1 billion. And the management team of Quaker Oats said, oh, you don't understand, and you don't see what we see. We're inside. We see all the potential value. And we will show you, market, that we actually did not spend too much. And they worked very, very, very hard, very hard. And at the end, after working very hard, they sold it to a private equity firm 28 months later. And they tried their best, and they sold it for $340 million, 20% of the purchase price. What a disaster. What a disaster. They spent $1.7 billion, and after working very hard, they sold it for $340 million. They destroyed about $1.4 billion of value. And as you can see, the analysts on Wall Street around the world were able to figure out very, very quickly, because of everything they learned in an MBA program. They learned strategy, they learned about the marketing, they learned about the operations, very important topics. They learned about leadership, and they just couldn't see how this was going to be positive. And clearly, the analysts were right. Spending $1.7 billion by Quaker Oats for Snapple was a disaster. The management team was replaced. The board of directors fired the CEO, and this was not good. So again, one other thing you should learn in this master class, but also, of course, in business school, is, if nothing else, buy low and sell high. If you buy high and sell low, you're not going to be there long. And that management team wasn't. Okay, so I guess that was the wrong price. So what is the correct price? Well, let's look at another example. Here is a telecommunication company called AirTouch. They were trading at $68 a share. And suddenly they get a bid, and they get a bid to be acquired by Bell Atlantic. And Bell Atlantic says, we'll pay you $73 a share, a 7% premium. And of course, the shareholders of AirTouch are happy because they went to bed one night and the stock was at 68, and they woke up the next morning and the stock was at 73. That's pretty good. So the AirTouch shareholders are happy. The Bell Atlantic shareholders are not so happy because you see the market reaction, and Bell Atlantic stock goes down on the announcement by 5%. So that's not so good. Okay, but now the company is in play. And in the background, there are lots of phone calls between investment bankers, people with an MBA, consultants also with an MBA, accountants, and lawyers. And they say that it seems like AirTouch is being acquired by Bell Atlantic, and some companies are saying, we can't let this happen. We can't let this combination happen because it will put us at a competitive disadvantage. So strategy comes in, thinking about competition comes in, and suddenly there's another bid. And it's a bid by Vodafone. And Vodafone says, forget it, we're buying AirTouch. And they offer $97 a share, 43% premium. And again, as you can imagine, the AirTouch shareholders cannot be more happy. They went to bed, the stock was at 73 after the bid from Bell Atlantic. And they woke up the next day, and now the stock is at 97. Wow, they're definitely doing well with their investment. And what's surprising is that the market reaction for Vodafone stock is also up. So I don't understand. Is the market crazy? If you buy something for 73, the market reaction is down. But if you spend 97, the market reaction is up. Why is that possible? How is this happening? Well, I'll give you the answer. In class, in the Socratic method, we would have you answer, but I'm sure some of you are thinking about it, and it's all around the synergy. Thinking about synergy between the companies, the synergy between Bell Atlantic and AirTouch, and the synergy between Vodafone and AirTouch. And the market doesn't see much synergy between Bell Atlantic and AirTouch, but they see a lot of synergy between Vodafone and AirTouch. What is synergy? It's the value that is created as a direct result of the combination of two companies. There are lots of ways to think about synergy. Revenue synergy, cost synergy, process improvement synergy, tax synergy, financial engineering synergy, lots of ways to analyze it. And in class, what we do is we analyze it carefully. I'm not going to spend as much time, but in essence, what is revenue synergy? It's when 2 plus 2 equals 5. Somehow by combining these two companies, you can achieve higher sales growth together than you could have achieved with each company on its own. 2 plus 2 equals 5. The added 1 comes because of that synergy in the revenue. Now, there's also cost synergy. 2 plus 2 equals 3. Well, how is 2 plus 2 equals 3? Well, because by doing this combination, you can eliminate expenses that are no longer needed when the functions are consolidated. You don't need 2 CEOs. You don't need 2 CFOs. You don't need many things that are duplicated by combining these two companies. So if we do a merger, we can take out a lot of the costs. Sometimes we look at process improvements. By combining these two companies, we can transfer the best practices and core competencies between the companies. Maybe one company, like the target, is especially good at something, and the acquirer wants to buy that something and learn from it. Or the acquirer can improve the target's performance. And this is something like private equity. In private equity, many times Blackstone or KKR or Carlyle, those acquirers, will look at those targets and say, you know what, it's not functioning so well. We at Blackstone can come in, we can buy them, we can fix them, improve the performance, the target performance, and then we can sell them back to the capital markets. And that's what private equity firms do, financial buyers do. They don't buy it because it's strategic. They buy it because they see an opportunity to improve the target's bad performance. Okay. Sometimes there are tax benefits, and by doing a combination, you can avoid some taxes that will create value. And sometimes by combining these two companies, you can create value by potentially having a lower weighted average cost of capital, which for people who don't know what that is, I promise in finance courses, you'll learn all about the WACC, the weighted average cost of capital. And by reducing the WACC, or by improving certain things, you can actually create value. And again, lots of examples that you will go through. But there are lots of opportunities to create synergy. And synergy is the value that is created, the direct value that is created by combining two companies. Now, lots of other terms you'll learn about, this intrinsic value and market value and purchase price and synergy value, which we just said. But in essence, let me just summarize. Intrinsic value is just the value of the company. It's the present value of the future cash flows. The market price is whatever the stock is trading at, whatever the price of the company is trading in the market at. It could be higher than the intrinsic value. It could be lower than the intrinsic value. Warren Buffett, who you'll learn about in business school, has become a very successful billionaire, as you know, worth over $100 billion, not because he invented Microsoft, not because he invented Meta, not because he invented Amazon. That goes to Bill Gates and Mark Zuckerberg, or it goes to, Jeff Bezos. What Warren Buffett did is just figure out when the intrinsic value is higher than the market value and buy those investments. And that's how he made his money. So intrinsic value is the present value of future cash flows. You'll learn a lot about this. Market value is whatever the stock price is trading at that moment in time, which is a function of supply and demand of buyers and sellers. Now, there could be a purchase price if we're talking about an acquisition, and we already mentioned synergy value. And hopefully, there's a lot of synergy. Hopefully, there is a lot of synergy that goes and is distributed both to the shareholders of the target, and that's why the shareholders of Target are happy when they wake up in the morning and they see their stock price go from 68 to 73 or 97. That's the value that goes to the shareholders of Target. But hopefully, there's also enough synergy value that some of it is left over after paying the target that is remaining for the acquired shareholders. But as I mentioned, history shows that most mergers and acquisitions destroy value, that the synergy value is overestimated. Too much of it is given away to the target shareholders, and the acquirer shareholders end up with a negative NPV. The acquirer shareholders end up with negative value, and that's why their stock price typically goes down. So when you open up the Wall Street Journal or the Financial Times or CNBC or any financial website and there's a deal announced, typically you should know that the shareholders of the target company are going to be happy, and the shareholders of the acquiring company are not going to be happy. Their stock is going to go down because typically it was negative NPV. All right, Well, that's a little theory. And again, we're rushed because we have many things to get to, but in class, we would spend a lot of time. And we would use that theory and apply it to practice with lots of examples. And I gave you an example of a company in Australia, a conglomerate, a very big company, a very successful company that's in different businesses. It's traded on the Australian Stock Exchange. They're in the wine, water heater, and packaging business. And then they bring in the strategy consultants, McKinsey, a top-notch firm, excellent firm. And they bring in McKinsey, and McKinsey says, you know what? In today's world, being a conglomerate does not make sense anymore. Being a company that's focused on multiple industries does not make sense. You should be a pure play. You should focus. You should understand what you're good at and do that. And you should focus on core business. And they decide to focus on wine. They're going to sell the other businesses, water heater and packaging. So in mergers and acquisitions, often there's lots of sales, which means others are buying those. And you're going to focus on one business. And that is the wine industry based on their recommendation. And part of the reason is because of growth. You should know that there are a number of important words in valuation. One is margins. What are the margins you're generating? And growth is another one. Now, I mentioned McKinsey. Here's some information from BCG. And BCG also looked at this conglomerate discount and identified that companies that are conglomerates, that are in multiple businesses, actually trade at an historic discount to their sum of the parts valuation. If you kind of took a conglomerate and broke it up into pieces, the sum of those pieces, the sum of those parts would be worth more than where the conglomerate is trading. The conglomerate discount is historically around 14%, according to this research from BCG. So the advice from McKinsey to Southcorp management team, the advice from BCG to other clients is maybe you should be a pure play. And we're seeing that here in the US, the conglomerate that all of us know and heard of, General Electric, has been spending the past decade trying to also move to be a pure play company. But that's kind of the company most people would say is the conglomerate they know best. But even it has moved off that strategy to be more of a focused strategy. Okay, so they're going to focus on wine. And the question is, what should they do with all the money they just raised from selling the water heater and packaging? Should they take that money and distribute it in the form of a special dividend to the shareholders? Well, that's one option, and the board of directors has to consider it. Or should they take all that money and make an investment? Should they do a capital budgeting decision? Should they take that funds and bet on something? Well, they decide to do that. They decide to buy a company. They decide to do an acquisition. They decide to look at this company in Australia called Rosemont and to buy it out. Now, this company is privately owned. It's managed through the Oatly family. So the culture is very different. They're very, very successful. They're best #1 selling wine in Australia. They're second best selling Australian brand in the US market, which is a very large market. They are efficiently run, so their operations are tight. They don't have a lot of waste, 750 people. And the numbers, the finance is out of this world. They have very high growth. We talked about growth before. They have very, very high margins. So when you combine growth and margins that are outstanding, people are saying this company is one of the best companies in the world, and they decide to buy it. But again, should they buy? Well, what creates value and what destroys value? Well, we talked about things that potentially create value. Market power hypothesis, 2 + 2 = 5. Operating synergy. 2 plus 2 on costs equals 3. Financial synergy. Maybe we can reduce tax. Maybe we can improve the operations. All of these should create value. What are things that don't create value? Well, ego. When management says, I really want to do this deal, it doesn't matter how much it costs. We need to buy this company. Well, it might cost you too much. And if it's too much, it means it's negative NPV. You wasted money. Growth. Well, growth sounds good. Why isn't growth on this side? Well, growth can be very good and growth can be bad. If the company is generating negative margins, you don't want to grow. But if the company is generating positive economic profit, you do want to grow. So this growth depends on the situation, the financial situation of the company. And then the diversification. We talked about that. Conglomerates are not so good. You should be a pure play. Diversification is very important. The diversification says shareholders should be diversified, but the company should be focused. The company should not diversify on behalf of shareholders. Rather, shareholders should own companies that are diversified portfolio. The shareholders should diversify, not the company on their behalf. So positive and some negative. And then the question is, should we do this deal? Lots of, in the whiteboards at Goldman Sachs and BCG, there are lots of for and against, pros and cons, like synergies or lack of synergy. There's a strong brand, but there's a different culture. There's a joint venture with Mondavi in the US, but what about the antitrust authorities around the world, in Australia and Europe and the US, the DOJ, the Federal Trade Commission, the legal issues? The credit rating agencies are saying, if you do this deal, we're going to downgrade your debt. Is that a problem? Is that a deal breaker, or is that just a cost of doing business? And there's, of course, growth and synergy. So what should we do? And the price is 1.4 billion. So lots of questions, lots of things we need to think about. And again, time is running out. So in class, we would explore all this. If you're a mergers and acquisitions advisor, as a consultant, as a banker, as a lawyer, as an accountant, many of these issues are issues you will be dealing with all the time, providing advice to your clients. Now, if we think about valuation, is the 1.4 billion good? Well, I mentioned relative valuations before. The PE, the price to book, the price to sales. There are lots of ways to do valuation. And if you look at this, we can compare this transaction to other similar transactions, other comps, comparables. And the bankers have to go and find those comparable transactions. And they did. Allied bought Montana, Foster's bought Behringer, and this is what they paid. They paid this multiple for the earnings before interest and taxes, the operating profit, which is on the income statement. You'll learn that in financial accounting. Very important topics. So this is the comparables, and when they calculate to see how much are we paying for Rosemont, it seems that on a multiple basis, we're paying 13.1. Are we overpaying? Well, this doesn't say we are. It looks like we're paying very fair price. And you can look at it also by looking at the other years. And again, it looks very, very reasonable. Now, some people would say, well, what's the accounting for mergers and acquisitions? In your financial reporting class, you paid 1.4 billion. You allocated all the purchase price into the fair market value of the net identifiable assets, liabilities, equities, balance sheets, income statements, statements of cash flows, your financial reporting course in business school, and you will learn of this concept called goodwill, which here ends up being 700 million. Half of this transaction is this one asset called goodwill. It's an intangible asset. Not only is this an intangible asset, within the 695, we have a brand that is valued at 590 million. That too is an intangible asset. So we have 590 of the 695, and 700 million. So 1.29, 590 plus 700. 1.29 of the 1.3 are two assets, brand and goodwill. Is that good? Is that bad? What does that mean? And how do we do even brand valuation? So again, in finance courses, we will learn about this. We'll understand this. Lots of ways of doing it. But we're not going to do it today because of time. For that, you have to go to business school, a business school that's positive NPV for you. And if you look at the brands, how do we come up with these brand valuations? And by the way, this is not even today. This is a couple of years, because now the Apple brand over the past couple of years has gone from 214 billion to be worth over $450 billion. How do you come up with that? But for that, we need to go to business school and learn more. And this case is a rich case. It has an A and a B and a C and a D, and the story is an unbelievable story. But for that, you'll have to, again, maybe spend more time, understand these issues. For today, what I wanted to do is just highlight a few things. One is that these are capital budgeting decisions. What's a good investment? What's a bad investment? Mergers and acquisitions are often bad investments because they end up being negative NPV. How do we as advisors at consulting firms like McKinsey or Goldman Sachs investment bankers, or lawyers at Cravath and other top law firms, or accountants at PwC and KPMG, and how do we make sure to give our clients the best advice? And if we're the client, if we're the management, how do we make sure that we make investments that create value for our company to increase firm value? So with that, let me say, I hope you learned some things. I know you will learn a lot more if you go to business school. And let me turn it back to Paras. Thank you.
Thank you, Jake. Super insightful, and so many questions are coming in. For all the folks that are here, if I can request you, if you have more questions, please keep posting them through the Q&A chat box at the bottom, the Q&A section at the bottom of your screen. We'll try and take as many questions as we can. Jake, I'll take a few right now, and then we'll move to Winston for a quick presentation as well about ASB. But love the case, especially when you were talking about the Coke versus the case at that stage as well. So there's a question that's come up around that, which I want to take first up. Right. So the folks and bankers advising Coke to acquire Quaker, two must have been an MBA. If they made such a mistake, how does an MBA prepare you to avoid such mistakes?
Yes. So I'm sure they were MBAs. So first, let me say that. How do you avoid such mistakes? Well, you go to ASB, where you learn how not to make those mistakes. But truthfully, joking aside, is a lot of it is your view of the world. So truthfully, you're not always going to be right. Many times you'll be wrong. But it's really how you analyze the data and how you think the company will be able to move forward. Many times you will get it wrong. And but by practice, you will hopefully do it better. So experience is very, very important. In fact, if you look at mergers and acquisitions, which ones are successful and which ones are not? Well, I said most of them fail. But if you look at the ones that are successful, the ones that are managed through teams who've done this over and over and over again, who are really quite experienced in it, are ones that tend to be more successful. Now, again, it sounds obvious, but it is, that experience is very helpful to be more successful. If, on the other hand, you're fairly new to it, there's a good chance that you'll fail.
Thank you, Jake. One more question, and this comes from Sneha, who's saying, how do macroeconomic factors influence the timing and success of an M&A activity, especially keeping in mind the current economic downturn?
Yes, absolutely. So macroeconomic conditions play a critical role in it. Things even like the interest rates have gone up. So what does that mean? Does that create a chill for various transactions, especially in private equity? Other issues that are very important, in fact, right now, top of mind for mergers and acquisitions are the new regulations that the Biden administration has suggested. And there's a new new chair at the FTC, Lina Khan, who's been a little tough on tech companies and suggesting various regulations. So whether it's macroeconomics, whether it's regulatory environment, all those could have an impact on mergers and acquisitions. So all those are important issues to understand, and all those are topics we cover in business school. So when you come to business school, you'll take the core courses like finance, financial reporting, strategy, operations, leadership, etc. But also you can focus a little more on regulatory. You can focus a little more on things like antitrust. You can focus more on macroeconomic, which is very, very important. So all are important topics that in business school you will learn.
Great, and one last question. There's quite a few more coming in, so please, for all the students here, please keep posting. Jake, one question before we take the presentation from Winston, and then we'll come back to more questions. Priyanka asks, how do valuations work in the crypto market, given just the volatility and the game that plays in?
Yeah, so it's very complicated, to be honest, because in the crypto market, at least as far as I know, you can't calculate the intrinsic value. It's not like you can calculate the way Warren Buffett does valuations for companies. As I mentioned, he calculates intrinsic value. Intrinsic value is the present value of the future cash flows. So he will look at an asset, he will look at a company, and try to project how much cash is this company going to generate from next year until forever. And that is something he does very well. In crypto, there is really no intrinsic value to cryptocurrency. It's really only a function of what you think someone will pay for it in the future. So it becomes a lot more speculative, and that's why you're seeing the very high volatility in the crypto space, whether it's in Bitcoin or other digital currencies. It's very, very volatile because of the speculative nature. There is no, future cash flows to discount. There's just what do I think I can sell it to someone else in the future, which some people would say it's the greater fool theory, and that's why many people have shied away from crypto. But I'll also say that I'm not a crypto expert, so take that with a grain of salt.
Great, and there are more questions coming in, but we'll quickly move over to Winston to talk a little bit about, we've spoken about, Jake referred a few times about how an MBA can be influential in that decision choice as you make thinking about M&A or careers within the consulting space as well. Winston, talk to us a little bit about ASB and how it prepares you for the world ahead.
Okay, thank you, Paras. And hi, everybody. Thank you for joining us this evening. So I'd like to quickly run through the school I come from, ASB. My name is Winston. I lead the admissions effort here at Asia School of Business. Now, Asia School of Business is a relatively young school. We're 8 years old, established in 2015. And this is in collaboration between the Bank Negara of Malaysia, which is the central bank of Malaysia, as well as MIT Sloan Management. So really, really strong parents there. Now, we talk about, just now there was a very interesting question about MBAs and why did they make a mistake in an M&A class, in an M&A case, but there are MBAs and there are MBAs. So I'd like to tell you what's special about the MBA program that we run here at Asia School of Business. Firstly, the curriculum is innovative. This is based on MIT's pedagogy. Secondly, the front and center, the core of our MBA program is the action learning. Through action learning, you have access to top companies in the region, you talk to the top business leaders, and then you get into the head, what keeps them up at night, what what trends they are looking out for. So that exposure is not often found at many other MBA programs in the world. I'll elaborate about that later, right? And also in the program, you're taught by both MIT visiting faculty as well as ASB resident faculty. And we're talking about senior faculty like Jake himself, who teaches on the program. And of course, elephant in the room, career development support. We do have a very strong career development office. How strong? I'll show you the report card later. And the fifth part and really important part is also beyond the ASB MBA, you have extended learning opportunities. So we'll explore that in a minute. Now, talking about the MBA program, this is a 12-month MBA program. It's really intensive. You spend 3 semesters here at ASB, and then you go on to MIT for an immersion week. So for an immersion for up to 3 weeks, my apologies. And up to 50% of your course is actually taught by MIT professors, right? So this could be people like Jake himself flying into Malaysia to teach a class, or when you're up in Boston for your MIT immersion for that 3 weeks. And as you go through the academic program, you would also go through the action learning program, right? Through the business practicum, for example, the entire class would actually go into a company. You embed yourself in the company, joining, you will form different teams, joining, you would be understanding different parts of the company. And then in the evening, you come back and you share notes about what you observed and what you think is going on well with the company, what you think is not going so well with the company. And this is done with the facilitation of business coaches, with the faculty. And at the end of the week with the company, you actually make a presentation to the top management. So this level of access is not found at many MBA programs. And talking about that, the faculty that you'll be learning from, well, you just had a very enjoyable masterclass from Jake. He teaches in the MBA program together with some of his MIT colleagues as well. And if you can see, this is just a representation of some of the faculty that teach on the program. Some of them are based here in Kuala Lumpur, and some of them fly in. And some of them you will meet when you're in Boston for your MIT immersion. And I talked about, the brilliant work that our career development office and hard work they've put in. For a school that is so young, at 8 years old, our last class of 2022, 90% of them were placed within 90 days. And we can look at the list of brands. So these are companies that have hired our graduates. And in fact, historically, we have good graduates in some of the top consulting firms. So in McKinsey, in Bain, in BCG, as well as the big fours. But that said, I do have a disclaimer. It is not served on a silver platter for you. So our CDO colleagues work hard for you. They will knock on those doors, but you have to work as hard as well to open those doors, put a foot in, and then, impress the employers. So what happens upon completion of your program? Upon completion of your program, you will receive an ASB MBA degree, and you will also receive an immersion program certificate from MIT Sloan. You would be an ASB alum, and you would also be an MIT affiliate alum, which means you get an MIT alumni email for life. You are invited to MIT alumni events. So phenomenal networking opportunities. And for those of you who feel that, look, this is a very intensive 12-month program. I'm so excited about what I've learned. I want to learn some more. What other opportunities are there beyond the MBA program? First, you can extend your stay at ASB for another 4 months as an entrepreneur in residence. Okay. You can also apply to continue your studies at MIT as a visiting fellows. And very especially, I would like to draw your attention to option number 3. You can enroll in a 9-month, the Master of Science in Management Studies program for MIT Sloan, or what we call the MSMS. Now, the MSMS is a really special program in which it is not open to the public. You can only apply to the MSMS if you have graduated from one of the 10 partner and affiliate programs to MIT Sloan. So ASB is one of those, as well as other programs from Tsinghua, from Fudan, from INSEAD. Now, if there is anything you want to take away today, I really want you to think about affordable access. What do I mean by affordable access? Imagine if you were to go to the US for a 2-year MBA program, the tuition plus cost of living would easily have set you back for about $200,000 US for the 2 years there. If you were to come to ASB, well, we're situated in Malaysia, where cost of living is really comparatively lower. So your total cost of education is low. Secondly, the tuition for your 12-month MBA program is at $35,000 US. So imagine that, a full MBA program for $35,000 US. Now, even if you were to go on to do the MSMS at $80,000 US, that only sets you back by 120 or so in tuition cost. And the MSMS is a STEM designated program, which means after you graduate from the MSMS program, you can continue to work you have work authorization in the US for 3 years. So you still have that access into the US career opportunity, but at a much lower cost of education. So affordable access is something I want to think about. Well, if you do have further questions, I'd love to take them. Meanwhile, our student, Sudhanshu, is actually in Delhi right now, and he has agreed to host a coffee chat. So if any of you is in Delhi, you can scan the QR code and look at the list of events that you can sign up for. In fact, personally, I would be visiting India in the first 2 weeks of September. So I'll be in Delhi, in Chennai, Hyderabad, in Bangalore, and Mumbai, of course. So feel free, reach out, scan the QR code and sign up for an event. Thank you, and over to you, Faraz.
Thank you, Winston, and great to learn about the opportunities that ASB offers for folks looking at MBA program. Now, there's tons of questions coming in. There's about 20 that we have to get through, so I'm going to try and speed through some of them. First one, Winston, I'll bring to you. Molly Priya says she has 4 years of experience in PE, and I'm keen to study at MIT Sloan. I plan to look at the 2025 intake. Amongst the interest tests and other things, should I prioritize the best chance of getting into, should I prioritize certificates and other entrance tests as a priority, as a way to look at ASB or MIT? So given that background of 4 years of experience in PE, wants to look at the 2025 intake, how does she prepare herself well?
Sure. I mean, that's a really good question. I can't answer on behalf of MIT admissions, but for ASB admissions, we do look at the candidate holistically. I mean, it's great that you came from PE. That's good career background, but we also would also look at how are you in terms of academics, whether you have the affinity towards quantitative ability. So if you have not already taken the GMAT, I would strongly encourage that, the GMAT or the GRE, because the standardized test would give us a good way of understanding your academic ability. Of course, for those of you who have not gotten a very high GPA because you had too much fun in college, then a good standardized test score always helped. Apart from that, we also require you to have a recommenders letter. So a strong letter from maybe your manager, that would really help. And then the final step in that process is where you get to do a Zoom interview with the admissions committee, and be true, be yourself, and show us beyond grades, beyond career, who are you as a person? What is your leadership potential? And, show us how are you going to improve the livelihood of others? How are you going to make a positive impact on society? So that's what we're looking out for here at ASB.
Great. Thank you for that, Winston. Jake, you wanted to say a few words before I take out all the questions?
Yes, I'd like to just build on what Winston mentioned, which for me is very important. And as he said, the key is affordable access. And I think that's really what's special about ASB and this opportunity, because you should all be thinking about whether this investment is positive or negative NPV. Going to school and going to study is an investment decision, just like buying a company is an investment decision, and we just discussed. Is it going to be a positive investment or a negative investment? It is very true what Winston said, that coming to the US to study for a 2-year MBA program can cost you, and according to Poets and Quants, and I encourage you to go and look at the website, it's around $200,000 to $250,000. That is a huge investment. And many times, those investments are negative NPV. I would argue that only if you go to a few schools in the US at that level of investment, it's still positive. And I worry about tuition. As a dean at MIT, I take that very seriously. And I understand that it could be a problem. But if you go and study in the US at a school that's not necessarily a top school, I would question whether that's a positive NPV investment. In fact, I would tell you that you're making a mistake because the tuition is so high. So to Winston's point of, it is very important for us at ASB to have affordable access. It's very important for us, as well as our parent, BNM, Bank Negara Malaysia, the central bank, to make sure we provide students with opportunities that are good investments. So I would take a look at that and think very seriously about how much you're looking to spend on your MBA and where can you get the most value for your investment. I think ASB and everything we design there with the 1-year program, the opportunity to continue on and study if you so choose for a second year in the MSMS or elsewhere. But thinking about that value proposition, it is by far the most attractive. I would also encourage you to look at some of the Poets and Quants articles that include Sanjay Sarma, the new president of ASB, who was vice president at MIT for 10 years. And that article, which we can also send to you, is very good about the value proposition. Remember, positive, negative NPV. Make good investments for yourself. Thank you.
Thank you, Jake. Thank you for that. Now, as the questions are pouring in, I want to take a quick minute before we take on with more questions. Just do a quick poll for folks that are listening in. You will see a poll come up on your screen just now. It should show up any minute. Now, you've heard about ASB. You've heard a lot about why you should consider this opportunity as well. Tell us which unique feature of the ASB program appeals to you the most. Is it the curriculum being taught by the MIT Sloan and ASB faculty? Is it the 3-week immersion program at MIT Sloan's campus in Cambridge, Massachusetts? Is it the option to continue your studies at MIT in the Visiting Fellows program? Is it the option to pursue a 9-month master's program at MIT? Or is it all of the above? So which of the unique features of the ASB MBA program appeals to you the most? The curriculum taught by the faculty, both at MIT Sloan and ASB, the 3-week immersion program at MIT Sloan, the opportunity to continue studies at MIT in the Visiting Fellows Program, the option to pursue a 9-month master's degree at the MIT Sloan School, or is it all of the above? So if we can take a quick second to answer that. We're going to close the poll in the next 10 seconds. Which unique feature of the ASB MBA program appeals to you the most? All right, let's see what answers we're seeing now. Fantastic. So a large number of you have said all of the above, which is great to hear. Good 10% have spoken about the faculty, 10% have spoken about the opportunity to study via the Visiting Fellows Program, and 10% have spoken about the 9-month master's degree as well. Wonderful. So with that in the background, let's take a couple of more questions. Jake, let's go back to the masterclass for a few minutes. There's Meenal who's asking about how can due diligence help mitigate risks during the M&A deal?
Yes, very good question. Due diligence is very important. In fact, all companies are going to go through a very robust due diligence. They'll have their advisors help with all of it to make sure they really understand the landscape, whether it's the macroeconomics, which we spoke about, whether it's the competitive landscape. And a lot of the advisors, and many times I believe you are interested in those advisory roles, whether it's the investment banks or the consultants, a lot of that work will be around due diligence, making sure that the company that they're looking to buy actually does what they say they do, thinking about how the combination will work, and whether it's going to be a good transaction or a bad transaction. I didn't necessarily want to give you the answer to the South Corp case, but let me just say that that was a terrible, terrible acquisition South Corp did on Rosemont. And a lot of it was because maybe they didn't fully understand the due diligence. Maybe they didn't understand the different cultures, and they paid a price which was fair, as we discussed, but because the cultures were so different and that due diligence didn't pick up on that, it created a big problem. But due diligence is critical. And the roles, your advisor roles as post-MBA graduates are often in due diligence.
Wonderful. Dhwani is asking, Jake, in the Indian startup, and this may be slightly similar to the US market in some comparison as well, but her question is, in India, startup valuations have been through the roof in the last half a decade. Now, why should companies consider M&A as an option versus raising more capital and going that route? So fundraising versus M&A.
Yeah, so again, typically it's mergers and acquisitions or doing some fundraising and developing something internally, organic. So it's acquisition growth or organic growth. And many times companies choose to do acquisitions because it's just faster. Instead of raising money and investing in R&D and trying to bring a product or service to market, they can just quickly buy a company that already does it. But as I said, often they spend too much, they overestimate the synergies, they don't really understand the problems that may exist, and the due diligence didn't pick up on culture issues or other, and it's a problem. It's quite interesting to see that the ones that are successful are the ones that have done it over and over with good advisors who are experienced, but most times growth that is organic growth is much better than doing it through acquisitions. So I would definitely highlight that. And I would say that probably the best example is Apple. Apple has been a company that grew to, as we mentioned earlier, over $3 trillion in valuations. You all know this company, and the number of acquisitions they did are very few.
And Jake, one more question for you, and then I'll move on to Winston as well. You spoke a lot about the NPV and having a positive NPV. Rishi is saying, if an asset has positive NPV, then why would the owner sell? The owner's interest would always be in overpricing the asset.
Yes. So again, the NPV, as we see from the synergy, is by combining the two companies together. So it's true that in the negotiations between the buyer and the seller is going to want to take as much of that synergy value, the value that is generated by the combination, to them. But hopefully they'll understand that if the advisors on the other side understand that if we pay too much, it's not worth doing this deal, then they're going to back away as they should. Then maybe it's best to just negotiate. The negotiation skills, in fact, some of the faculty from MIT who teach at ASB are great faculty who teach negotiations. And by the way, I have to say that the resident faculty at ASB are superb. So the value is not just by MIT faculty coming in. The resident faculty at ASB, the staff is fully dedicated to your success. But in the negotiation courses, you will learn that there is something called ROPA, R-O-P-A, range of possible agreement. And as you think about the ROPA, the range of possible agreement, it's best if there's a win-win. If there's only a win for one side, then it's probably going to fail. It might not even go through. But if there's a win-win, both the seller wins and the buyer wins, there's synergy value that's distributed to both. That is the best for really the transaction overall.
Fantastic. Thank you, Jake, for that. And Winston, I'll come to you with the next few questions. Some of this you did cover through the presentation, but it might be good to reinforce for folks that have asked as well. So Rohit asks about the alumni status. If he does the ASB program, does he also get the MIT alumni status as well?
Yeah, so you would be inducted as affiliate alumni of MIT, which means that you get an MIT alumni email address, which you can use for life. You also get invited to MIT alum activities. So wonderful network there.
Great. There's a question from Prem for you, Winston, who says, I have 5 years of experience right now. Should I wait and do an executive MBA in a couple of years, or plan to pursue an MBA, a full-time MBA now?
Well, it really depends on personal circumstances, because you know, for MBA it's a full-time program, which means that you do need to take a career break. But then again, if you wait later, then it makes it harder. Your opportunity cost is going to be much higher taking that career break. If you were to then wait for a few more years and take an executive MBA program, which tends to be a part-time or a segment-based program, then you would be juggling work responsibility as well as intensive studies. So it depends on really personal choice, personal circumstances. In my career, I've seen many students who started out as part-time students, and then they realize that I can't cope anymore. I need to focus on this full-time. So really, it comes down to the individual.
Great. Okay. And then, Winston, you spoke a lot about the career opportunities that the ASB.
Maybe I would just add, if I may, that of
Please.
course, as you know, at ASB we have both an MBA as well as an EMBA. So to Winston's point, it's really a personal decision. If you think it's best for you to take 1 year full-time studies, then an MBA makes sense, and 5 years of work experience is right in line with what most MBA students have. But if you prefer to continue to work and then later think about ASB for your EMBA, you get a lot of the value that we discussed, except it's more on a part-time basis. You continue to work in your organizations and you do your studies, but as Winston mentioned, that could bring other challenges because family, work, it's just a little more to juggle.
And I can add for folks listening in, you know, when you think about an executive MBA, traveling in parts of Asia or the Middle East are normally easier. So Malaysia being in close proximity to India can also be an advantage in that case. Winston, I'm going to bring the next question to you, just related to careers a bit more. Isha says she intends to return to India post her MBA. Do you have any placement support, or how do you help people going back to their home countries?
Yeah, so I would not use the word placement support, but rather when you're matriculated as a student, you get, I would say, the best careers support, attention, bar none in the world, seriously. And I do come from some of the top business schools in the world before I joined ASB. So what we are doing here is career preparedness, right? With the career development office, with the coaches that we have hired to help you through that journey, you are prepared to take on the opportunity rather than a direct placement service. Yeah, that's something that I always like to highlight to Indian students coming from India, because I would say the Indian university and colleges do an absolutely fantastic job with placement, but not everywhere else in the world.
Great. And on similar lines, a couple of more questions. Yeah, Yash Kumar says, what are the minimum and average GMAT scores for Indians applying to ASB?
Right. So because GMAT is not mandatory, but for those who have reported a GMAT score, our median GMAT, it's about 720. Yeah.
Okay. And do students with the GMAT have access to better scholarship opportunities or any other funding support?
Well, yeah, so we do have fellowships in various categories, one of which is academic excellence. So if you have a great GMAT score, for sure, you would qualify for that.
Great. The next question, and Jake, I'll bring you the next one or two questions here. There was a question from Thanu, who says, which factors determine a successful merger? And should the financial outlook be the most important factor for M&A, or is the long-term overall value of more significance?
Yeah, so hopefully the long-term value is built into the financials. So when we talk about discounting cash flows, we're talking about cash flows from next year until forever, in perpetuity. So hopefully that long-term is built into those models, and we have models from mathematics to help us solve those issues. So I think you should think about many things, but if it's a negative NPV, it's not going to be good. It's going to cause problems. The management team is probably going to be replaced. It's going to result in a stock price reflecting that negative NPV. We want you to make positive investments. We want you to make positive investments as managers doing acquisitions, and you should want to make positive NPV investment as you consider an MBA program. Otherwise you might have to fire yourself, because if you took on too many loans, if you took on a very high tuition, and later you couldn't necessarily convert that into the positive career opportunities you expected, then it's not good. So the best to always think about the financials and build into it other components, but the financials should capture those other components as well. Make positive NPV investment in M&A and in your career.
Fantastic. And the next question, and I think this may be something, Jake, that you can answer. Maybe Vincent, there's something you can add to as well. Arti says, and we're going to take two more questions, so I apologize for folks that have more questions. We're slightly running out of time, but we'll try and take maybe 2 or 3 more questions here. Arti says she's enjoyed the session. She's an HR professional with already a master's in HRM from UCD. She's looking to move into M&A consulting as the next step in her career. Any skills or suggestions that you have of what that she should pick up as she looks at her career transition?
Winston, do you want to suggest something? I'll go next.
Winston, can you hear us?
Right,
Let me repeat the question if you'd like.
No, yeah, so I got a question. I was just wondering if Jake was picking it up. Yeah, so an MBA program would be perfect for that, right? Because in an MBA program, you do learn your financial analysis. So for someone coming from a pure HR background, this may be your first exposure to accounting, to finance, as well as, the other aspects of how you measure the health of company. Yeah. Now, for those who don't come from a quantitative background, we do have what we call Quant Prep, which is a prep course that gets you on par, before you start your MBA program. Yeah. And of course,
yes, I would agree with Winston.
Go ahead, Jake.
I would second what Winston said. Getting an MBA would be very helpful. And truthfully, it's not even just for the accounting, finance, strategy courses, but to get an understanding of how business works. And the way you can do that is through our action learning. So action learning means taking all these skills and toolkits that you learned in the classroom and then putting them to practice while you're still within the academic environment. And it's safe, and you can practice, and you can learn. And if you make a mistake, it's not a big deal. But that kind of a safe sandbox to experiment is quite important. So getting an MBA where it gives you that experience potential is very, very helpful.
Wonderful. And with that, just to make sure we're conscious of everyone's time as well, for both of you, firstly, thank you for taking time and being here with us today. One last tip of advice that both of you may want to give for folks that are thinking about considering ASB and considering an MBA in more general as well. So Winston, if you want to go first.
Sure. I mean, I'm just going to be a broken record. I'm just highlight affordable access. Really, I mean, think about the total cost of education and how you're going to recoup that. Yeah.
Great. And Jake?
Yeah, so I'm going to build on what Winston mentioned, the affordable access, and put a business lens on it and say, make positive NPV investment. It is more likely to be positive NPV and very big if the investment is reasonable, and the affordable access is very important. So think about what creates the most value for you. And I think the ASB, I know the ASB, I've been involved with ASB since 2015, is an amazing opportunity that I would have all of you take a very hard look at, because it could be very, very positive NPV for you.
Fantastic. Positive NPV is a big factor as you start looking at some of these decisions. So thank you, Jake. Thank you, Winston, for taking time and being with us here today. For everybody else, thank you for joining in. We hope we were able to answer most of your questions, but if there are more, I'm sure the admissions team at ASB will be more than happy to be in touch with you as well. Winston, if you want to quickly just put up an email address into the chat box that folks can write to you at, that'll be great as well. But apart from that, thanks for joining today. We hope that this session gave you a good lens into the M&A spectrum, but also into ASB and the opportunities that they bring to you as well. We'll wait for a second for Winston to just put the email address in the chat. For folks that are here, please take the email address there. We will also circulate this after, so don't worry. You will have a chance to get in touch with them as well. With that, thank you, everybody. Thanks for joining in. Have a lovely evening.
Thank you.
Thank you, everyone.